The 2026 Irish budget has just been announced, but if you're a business owner, an investor, or someone that's planning for retirement, it's not the spending headlines that matter most to you. The real story lies in the tax changes and incentives, because that's what's going to move your needle. In this video, I'll cut through the spin and show you what's new, what's unchanged, and what it means for your portfolio, maybe your business exit plans and your long-term investing returns. We'll look at a deep dive into the new exit tax changes and what that means for investors and retirees. After that, we'll look at the revised entrepreneur relief and how the new 1.5 million cap affects founders and business owners. We'll then look at housing and property reliefs. Finally, we'll wrap up by looking at the winners, the risks, and where the smart money should position itself in 2026. So let's get started. So let's start with the big picture. The total budget package is €9.4 billion, but only 1.5 of that goes to tax measures. So this is not a giveaway budget. It's about preparing for uncertainty, as Minister of Finance Pascal Donoghue repeated in his address to the Dáil. There are no changes to the top income tax rates. Because wage growth continues, many people will quietly drift into higher tax brackets. In short, you could pay more tax even though rates haven't changed. A few small adjustments were made to USC, for example, where the 2% rate is now at $28,700. So a bit more of your income is taxed at that lower rate. The minimum wage increases to €14.15 per hour from January, and there were some USC concessions for medical card holders also. For companies, there was one bright spot, and that is the research and development tax credit jumps from 30 to 35%. This is meaningful for big tech and pharma companies. But the overall signal, the budget tightens quietly rather than loosens loudly. Now, I want you to keep that in mind, because every change we discuss from this point forward fits into the same disciplined pattern. Let's talk about one of the most misunderstood taxes in Ireland, and that is the exit tax. This is a tax that applies to Irish investment funds, ETFs, index funds, and life assurance policies. It controls how and when you're taxed on investment growth. Your investments grow tax deferred while they stay inside the fund. But under Irish rules, you don't just pay tax when you sell, you're also taxed every 8 years under what's called deemed disposal. That means you can owe tax even if you haven't sold anything. You can be down on value, but still tax as if you made a gain. Now, it's not just frustrating, it's distortionary. It forces investors to make decisions based on tax dates, not market data. Until now, the exit tax rate was 41%. That is well above the 33% for capital gains tax on direct investments. And for years, the 8-point gap difference made ETFs less appealing, especially for long-term investors and retirees. In the budget 2026, this rate is being cut slightly from 41% to 38%, and that change is effective as of January. From that date, any gains realized or deemed realized will be taxed at the lower rate of 38%. It is progress, but it's only a small part of what actually needs to change. In my article, Time to Fix Investment Fund Tax on irishtaxhub.ie, I outlined 3 essential reforms that still need to be addressed. The first is removing 8-year deemed disposal. The second is aligning exit tax rates with capital gains tax at 33%. And thirdly, introducing loss relief, so investors can offset losses just like they can with direct shares. What we received this year is 1/3 of that plan. The rate has shifted, but the structure hasn't changed. There's still no loss relief, there's still no change to deemed disposals, and there is still no alignment with the capital gains tax. So Ireland continues to penalise long-term, tax-compliant investing, the very behaviour the system should encourage. The irony here, exit tax system brings in a fraction of overall tax revenue in Ireland. Estimates suggest between 100 and 200 million, not billions. So it's a drop in the ocean compared to income tax, VAT, or corporation tax. So the fiscal risk of real reform is low, but the potential economic benefit is huge. ETFs are a perfect example. Globally, they outperform most active managers. They're low cost, they're diversified, and they're transparent. They're an ideal vehicle for long-term wealth building. But our tax system makes them look so unattractive. It drives people to hold idle cash instead of productive assets. Right now, Irish households sit on about €165 billion in deposits, most of it earning close to zero interest. Inflation is quietly eating away at this wealth year after year. Fixing this exit tax could help unlock that capital and push more people's savings into productive investments. Now, there is a little glimmer of hope. The Department of Finance has confirmed a wider review of the investment fund tax system will be published later this year. That review will examine the 3 reforms that I referenced: removal of deemed disposal, alignment with the CGT rate, and the introduction of loss relief. So yes, Budget 2026 gives us a very small win, but the real test will be whether the next reform package finally follows. Until then, Irish investors remain stuck in an outdated, inefficient regime that taxes paper gains, denies loss offsetting, and limits compounding over time. In simple terms, this budget gives us a gesture, not a fix. A 3-point rate cut is welcome, but it doesn't modernize the system. The direction here is right, the intent is there, but until the structures change, Ireland's investment fund regime will stay out of step with modern investors and will keep paying the price for simply doing the right thing. Now let's talk about one of the biggest talking points for business owners, founders, and anyone planning to sell or pass on a company. That is entrepreneur relief, and it is back in the spotlight. And this year, it's finally had a meaningful update. In simple terms, entrepreneur relief gives you a reduced capital gains rate when you sell qualifying trading business or shares in the business. Normally, capital gains tax in Ireland is 33%, but under this relief, qualifying gains are taxed at just 10%, a massive 23-point saving. But up until now, the lifetime cap was at €1 million in qualifying gains. The limit has increased to 1.5 million under the budget in 2026. That's a big deal for founders planning their business exit. Let me show you why. Imagine you sell your trading company and you realize €1.5 million in gains. Under the old limit, only the first 1 million was taxed at 10%. That is €100,000 in tax. The remaining 500,000 was taxed at 33%. Adding an additional €165,000 in tax. Taxed under the old system, the total will be €265,000. Under the new €1.5 million limit, the entire amount qualifies for 10% rate, and your tax drops to €150,000. That's an additional €115,000 in savings, real money that can stay in your pocket or go straight into your next investment. The conditions, however, remain the same. You must sell a qualifying trading business. It cannot be a passive investment company. You must have been actively involved in the business for at least 3 years and hold a significant ownership stake. The relief still only applies to lifetime gains, not per sale, and all of this is subject to the revenues qualification tests. Now, let's be honest, many advisors were pushing for more. Pre-budget submissions from the Big Four all called for the cap to move significantly higher, some suggesting as high as €5 million. But for now, the government has settled on 1.5. It's a modest expansion, but still a welcome one. For many small and mid-sized business owners, this change extends the runway and gives them more flexibility in exit planning. For larger founders, it's progress but not perfection. Anything above 1.5 million will still be taxed at the full 33%. That's why timing and structure really matter when it comes to business exit planning. You'll see more owners sharing equity with spouses, family, or even holder companies so that multiple people can reach that €1.5 million relief. It's smart planning, not avoidance. It still stays within the rules. The finance bill, which will be released later this year, will confirm the exact implementation date and conditions. So if you're planning a sale, watch that closely. The takeaway here is simple. Entrepreneur relief means one of Ireland's best value tax breaks, and a new €1.5 million cap. It's becoming more meaningful, especially for owners who've built companies over decades. But don't forget, 33% still applies above the 1.5 million limit. Missing the qualifying conditions and that 10% rate just goes instantly. The difference between getting it right or wrong can easily be 6 figures. So plan early, get advice, and structure your exit properly. If you want a deeper understanding, check out my video on business exit planning in Ireland. Now let's turn to housing. The 2026 budget focuses on support and stability, not on big new spending or major tax cuts. Here are the key measures that matter for homeowners, landlords, and investors. The first is mortgage interest tax relief. The government is extending mortgage interest relief, covering 2026 and 27. It applies to owner-occupier homes only, not rentals or investment properties. The relief is calculated on the increase in your mortgage interest compared with 2022 and is capped each year. This is a temporary cushion only, it is not a permanent change. If you're still carrying a mortgage, use the next 2 years to build up repayment capacity before the support phases out. Now, we also have the rent tax credit. This tax credit continues at €1,000 per person or €2,000 for a couple joined together. It mainly applies to rent on your main home and in some cases to student accommodation. The government has signalled that it intends to keep this credit in place for now, but the rates and duration will be confirmed later in the finance bill, which will be announced later this year. Next, we'll have the residential premises rental income relief. This relief for small landlords stays in place through 2027, provides an annual income tax deduction, not USC or PRSI, The relief amount increases slightly each year, but a clawback applies if the property is sold within 4 years. It's modest, but it helps improve the net rental yields. Next is vacant and derelict property grants. The vacant property refurbishment grant remains one of the most effective supports for bringing older homes back into use. The grant helps cover refurbishment costs, including VAT, for homes that have been vacant for 2 or more years. Once renovated, the property can be lived in or rented out under a registered tenancy. It's not a tax relief, it's a direct funding, and it can make a real difference on the return on a renovation project. This part of the budget is about activity, not speculation. It supports people who own, renovate, or rent homes, not those who hold property passively. So let's bring it all together. Budget 2026 doesn't rewrite the rulebook, but it does reveal where the government priorities really lie. For investors and business owners, it's a year of incremental shifts, not transformations. The exit tax rate cut from 41% to 38% is a small step, but is not reform. It shows the policymakers finally see how outdated the fund tax regime has become. And with a wider review of investment fund tax due later this year, we may finally get progress on the issues that matter: loss relief, deemed disposal, and the CGT alignment. Until then, unfortunately, it's business as usual. With the entrepreneur relief cap raising to €1.5 million, that is real progress, especially for founders planning succession or their exit. It's still capped, but it is a step towards recognizing how much personal capital is tied up in private businesses. On the corporate side, research and development tax credit increases to 35%. This sends a clear signal. Ireland intends to stay competitive for innovation, technology, and export sectors. On the property front, this budget is about activity, not speculation. Mortgage and rent supports are being extended, small landlord relief remains in place, and grants for vacant or derelict homes continue to encourage property reuse. These measures won't transform affordability, but they keep the market functioning and reward those who actually renovate or provide housing, not those who simply hold on to idle assets. Step back and you'll see a pattern emerge. Budget 2026 is very cautious, even conservative, but it's just strategically consistent. It rewards discipline, investment, and long-term thinking, while avoiding populist giveaways. There are clearly some pain points remaining: frozen tax bans, rising PRSI, and limited relief for ordinary workers. But the direction of travel here is clear. Ireland wants to retain capital, reward entrepreneurship, and encourage innovation. So what should you do now? Well, you should review your tax structures. If you invest through funds, note the lower exit tax and time your disposals carefully. Plan your business exit early and make sure your company structure qualifies for the full $1.5 million entrepreneur relief. Use all available property supports, mortgage relief, rent credits, refurbishment grants while they last. And above all, don't mistake stability for stagnation. In a high-cost, high-inflation world, discipline is a key strategy. I would love to hear your take on this. Do you see Budget 2026 as progress or just another holding pattern? Drop your thoughts in the comments below. And if you want a breakdown of how the 38% exit tax compares to 41%, or how the new entrepreneur relief caps impact real-world exits, hit that like and subscribe button. I'll walk through those numbers once the finance bill has been published later this year. Thank you for watching, and I'll see you in the next one.